Welcome to a discussion on coping with dormancy. Dormancy is one of the biggest problems faced by almost all mobile money implementations. In one of the recent CGAP surveys, 64% of mobile money managers indicated that less than 30% of their registered users are active. And sadly, active usage rates of even less than 10% are not uncommon. So why is dormancy such an issue? Well, dormancy is immensely important as it affects the sustainability of institutions offering the services. It costs money to acquire a customer, so every inactive customer effectively increases the cost of acquiring a single customer who is active. So a $5 per customer acquisition is not uncommon, but it's often higher. And this covers the commission bonus to agents, fulfilling the back-office KYC requirements, and a starter kit for customers available with some services. Furthermore, a high dormancy rate means that mobile money deployment is not realizing the full potential of the market in which it is operating, and thus creates inefficiencies. Let's have a look at some mobile money customers to see what the major drivers of usage or non-usage are in these accounts. Mohammed Tayyab sells TV and fridge covers in the streets of West Delhi. He opened his M-Banking account at the next-door telecom shop, which he visits almost daily to buy talk time. He was convinced to open the account because it was associated with one of the biggest banks in India, and also because he knew the agent. When he made his first transaction, he immediately received the confirmation message, which was a great benefit, he thought. He started depositing 50 to 100 rupees, about $1 to $2, almost every day in his account. He was using the account to save and withdraw for purchases of household items and for his business. After 6 months, when he went to the agent was closed. He needed to withdraw money to buy stock urgently. He called customer care, and they suggested 2 more agent counters nearby. But even they also said that they have stopped and the cash-in, cash-out business. So all the agents around him were dormant. He had 800 rupees in his account at that time. He thought he had lost the money. Finally, he found an active agent in one of the markets where he was selling goods. He immediately went to the agent to withdraw whatever balance he had in the account. While withdrawing, the agent asked about the PIN, something of which Tayyab was not aware. His earlier agent had not even told him about his PIN. Tayyab again called customer care and got a new PIN. He then withdrew the entire balance. He also decided that he would never use his account again because, firstly, he was not told when his local agent was closed. Secondly, there was no communication from the bank or the M-Banking company about the agent. Thirdly, he was not told about the PIN, and he thinks that he had a big risk. And fourthly, of course, there is now no agent in the area he lives. Suki is a vegetable vendor in Patna, Bihar. He sells vegetables in 6 different areas in Patna. He starts his day at 8 in the morning and sells until 8 at night. He opened an M-Banking account with an agent who is also his customer. He opened it as the agent suggested that the account belongs to one of the biggest banks. The agent is also one of his regular customers, and so he knows him very well and trusts him. He deposits about 100 to 200 rupees, approximately $2 to $4, every day in his account. He has been able to save a considerable amount at the agent. He deposits regularly at the agent's, and whenever the amount reaches about 5,000 rupees, he withdraws it and deposits it at the nearest bank branch. Suki also has a recurring deposit of 4,250 per month. This month, he is planning to pay this recurring deposit account from his savings at the agent. Suki is very satisfied with the account as, firstly, it allows him any time deposit or withdrawal. Secondly, it allows him to save any amount, as small as 10 rupees at some times. Thirdly, it is very easy to use and he gets immediate confirmation messages. Fourthly, he is very satisfied with his agent, as his agent is open until 10 p.m. at night and he can do transactions in the evening. And finally, there is one more agent that he also uses near to his house, so the entire system is very convenient. These two case studies illustrate some of the biggest challenges for customer adoption and activity, which are trust, accessibility or proximity of the channel, simplicity of the offering and interface, ability to transact in low values, liquidity of the savings, portability and interoperability of services offered, the promise of returns, and the affordability or perceived value of the service, as well as the product relevance. The two cases we discussed also touched on some of the challenges discussed above. The big bank brand encouraged them to believe in and open the account initially. They also knew and trusted the agents. Both of them had agents close by, and this made it easy for them to operate the accounts, so accessibility worked well for them, initially at least. But the later closure of nearby agents was one of the reasons that Tayyab stopped using the account. Both of them found the account very easy and simple to use. Tayyab, however, was not informed about all the features of his account. And Suki was very happy because he can deposit amounts as small as 10 rupees. Let's go through each of these issues now. Firstly, trust and security. Mobile money operators often have to face a compromise or trade-off between proximity, liquidity, and security. Each cannot be addressed in equal measure. For example, transacting at a bank might be more secure and liquid, but does not offer proximity. Conversely, transacting at the shop round the corner might not be equally trusted or secure, or indeed perhaps liquid. There are often low levels of financial and technology literacy and lack of trust in E&M banking channels to handle money. GCash, Smart Money, and M-Pesa benefited greatly from strong national branding of Globe Telecom, Smart Communications, and Safaricom. Trust can also be established through community relationships and a proven track record. Thus, in India, KGFS village branches are now trusted by the locals more than nationalized banks. So brand equity and salience goes a long way to building both awareness and customer trust. Accessibility and proximity. While cash is ubiquitous, access to bank branches and ATMs is limited, and for M-banking, some poor households do not have access to mobile phones. Bank location and timings are both usually inconvenient for the poor. Given agent economics, it is difficult to have an agent nearby for every customer, and this poses the big chicken and egg challenge that Mass and Radcliffe highlighted. You need a widespread agent network to provide convenient access and encourage customer use, but the agents must conduct enough transactions to survive from the beginning. MicroSave has found that around 60 to 80 transactions per agent per day are required for agent economics to work. Even though customers might not have access to the personal mobile phones, Echo's agents usually act as facilitators using their mobile devices to carry out transactions on behalf of customers. One of the most important reasons for the success of M-Pesa is its widespread network of its agents. Note from the graph how this grew almost exactly in line with the number of customers being served. Liquidity. Managing liquidity of cash and e-money is a significant challenge to deal with at various levels across the distribution channels. For a given outlet or reseller, customer demographics will drive excess demand for either cash or for e-money, depleting stock quickly and needing replenishment. For example, agents often take in large amounts of cash at the urban end of remittance corridors and thus have to rebalance by buying more e-money, whereas agents at rural ends of remittance corridors have to pay out large amounts of cash and make frequent trips to rebalance by selling their e-money for cash. Similarly, in areas where social payments are made through mobile money channels, agents are dispersing large amounts of cash in return for e-money and thus have to rebalance by selling their e-money in return for cash. Selecting agents with prior experience of handling large amounts of cash is helpful. Partnering with financial institutions like banks also eases liquidity management. Selecting multiple agents in an area not only helps to deliver the network effect and provide footprint for client coverage, it also helps with liquidity management. Simplicity and reliability. Customers are often intimidated by technology complexity, especially where they have a direct interface, for example, ATMs or mobile phones. Compared to swiping a card or signing a form, using mobile phones for banking and payments is still clunky, be it SMS, USSD enabled, or menu-driven. Simplicity and security are difficult to accomplish together, and a compromise is often made. MicroSave has found that M-Pesa customers face the issue of losing money by contracting into the wrong account. This is an issue that GCash and others also faced and resolved, and M-Pesa are now working towards. Many platforms are rolled out before the system is fully stable. Unreliable systems and downtime worry customers and decrease trust in the system. Agent-enabled models in India, despite the limitations of reach, are overcoming technology barriers facilitating adoption. Similarly, repeated use of technology help clients become familiar, and this can be suitably incentivized. Wizit, Safaricom, and Smart enable clients to experience and experiment with their services by lowering entry barriers and offering attractive promotions. To overcome the challenge of widespread illiteracy and innumeracy and to enhance customer protection, institutions are trying various approaches. These include enabling agents to carry out transactions for clients, for example, as done by Echo in India, linking numbers back to the mobile phone book, as GCash and M-Pesa are now doing, and using paper forms as requests and transaction proofs to safeguard transactions, conducted by Echo and GCash. Interoperability. Lack of standards and limited collaboration between players is currently a key barrier to interoperability. Often interoperability is not possible even within different systems of large banks. In India, the National Payment Commission of India has taken a major step towards enabling interoperability between banks for mobile banking. NCPI has introduced a common switch, the IMPS, that connects 20 large and small banks. IMPS works on common standards and processes and allows customers to transfer funds between any partner banks and their account holders. Thus, IMPS is similar to RTGS and NEFT that allow real-time settlement between banks and could provide a much-needed fillip to mobile banking. Ability to transact in low values. The inability to handle large volumes of low-value transactions at low cost is one of the significant barriers to financial inclusion. Airtime top-up in very small denominations has demonstrated the possibility of offering a similar proposition for financial products. MicroSave's market research repeatedly shows that one of the most popular features of Echo's account is the ability to deposit in any amount. Promise of returns. Clients, even illiterate ones, have the expectation of return from financial instruments. They compare the cost of and the returns from available alternatives, including informal savings groups, less trusted and higher risk instruments such as livestock, and so on. This is even more relevant in a price-sensitive market like India. Before subscribing to savings instruments, low-income customers seek to compare the returns provided. For example, a pension product study exhibited a near-uniform expectation of the value of monthly benefits anticipated at old age. Affordability and perceived value. While customers have demonstrated willingness to pay for financial services, this is dependent on their perceived value. Customers may be willing to pay for certain transactions, for example, remittance or insurance, but not for others, for example, ledger fees for savings account maintenance. Research has proved in different geographies that clients consider some transactions more important than others, as the perceived opportunity cost is higher, and so they are willing to pay a premium for these transactions. Willingness to pay is also dependent on the speed or proximity compared with alternative channels, which is why remittances are so often the anchor product for mobile money systems. When well-designed pricing is considered to be one of the top reasons for M-Pesa's success. M-Pesa does not charge clients for opening an account or for depositing in an account, but all other transactions are chargeable according to the value perceived and the willingness to pay. But it is important to understand market conditions. In South Africa, banks charge a 1% fee for cash in. This reflects the local market conditions and norms in South Africa. The success of M-Pesa, multiple offerings. The future of mobile money lies in multiple product offerings. It is important for mobile money companies not to limit themselves to offering only one or two products. There are a range of products that can be delivered through the channel and respond to the diverse financial service needs of customers. To achieve economies of scale and meet competition, service providers have to widen their product range by offering common infrastructure rails for multiple products to ride on. M-Pesa is a service provider that has enhanced its product offerings by widening the product suite through offering the M-Pesa system to literally hundreds of businesses. However, as recent MicroSave research on the effectiveness of using the M-Pesa system has showed, this has been limited by the poor API on which Safaricom is currently working and the cost of the basic money transfer transaction. As the interfaces between M-Pesa and businesses linking to the system improve and the costs of using the system fall, so a better cash-light ecosystem may well emerge. At present, M-Pesa and many remittance-based systems are used only once or twice a month for long-distance transfers. Until we offer a broader range of products at much lower costs, these platforms will not be useful on a daily basis and will not support savings services. They are thus prone to dormancy. Success of M-Pesa and its channels. In addition to multiple product offerings, M-Pesa customers also have access to multiple channels for transactions, thus making it more convenient to transact. These channels include around 20,000 agents, nearly 1,000 ATMs of the 7 leading banks in Kenya, debit cards, and of course the mobile. Access to multiple channels makes the proposition even more strong for end customers. Introduction of M-Pesa at ATMs significantly increased the use of the platform and allowed users to make larger withdrawals than agents were sometimes able to provide. M-Pesa also invests significantly in marketing the platform and the services it offers. These together protect it against dormancy. Turning to India, Echo is a service provider that does not have large-scale resources for marketing. Therefore, it has to be very strategic and innovative to make the most of every dollar spent. Echo has focused on the following in its marketing strategy. It established the most significant pain points for customers. The market research revealed that safety and security and ease and convenience were the two most important issues. So the entire marketing is focused on these issues. Since Echo did not have enough funds for above-the-line marketing activities, it focused on below-the-line marketing activities, such as street theater, canopies in front of agent locations, and so on. Echo then conducted detailed assessment of the effectiveness of these campaigns, and in response to this assessment, focused primarily on canopies. However, Echo cannot afford to pay for customers to register and then not regularly transact. Thus, the emphasis has always been on getting the right type of customers who will transact. Echo's promotions emphasize customer education using a flip calendar for the agent, which discusses the benefits of the account and how to use it. In doing so, Echo seeks to protect itself against dormancy. So in conclusion, we can see that dormancy of mobile money accounts is an expensive scourge. Ensuring that the incentives to transact, both for customer and for the agent, is essential. Customers need to trust the system and the agents that service it. The platform must be reliable, simple to use, and ideally interoperable to maximize network effects. The products offered must be relevant and cost-effective for the customer. And the mobile money service provider and its agent networks must constantly market and communicate the products and services offered. The combination looks straightforward enough, but it is remarkable how many promising starts have been compromised by unstable systems, poorly managed agent networks, and inadequate marketing and communication. I'm now going to hand over to Alida Fazal from CCAP, and we're really honored to have Alida with us, and I thank her very much for joining us. She has great experience and expertise in this topic, and I really look forward to hearing what she has to say. Thanks, Alida.
Thank you, Graham, for that very insightful presentation. So as Graham mentioned, my name is Alida Fazal. My role at CICAP is as the head of mobile money, but my experience in mobile money starts from around 2005 when I was the initial product manager for M-Pesa in Kenya. And since then, I've been working on a number of mobile money initiatives around the world. Before I continue our discussion on coping with dormancy, I'll just make a quick introduction to CICAP and our work in the mobile money industry. CICAP provides solutions for leading operators around the globe. We started in 1994 as a department of Swisscom and have since grown into a company that delivers innovation and experience in a number of value-added services for mobile operators. So we have a customer base of over 120 mobile operators, and these are spread about across 75 countries. So we've had plenty of opportunity to observe mobile money in action. Moving on now to our discussion on dormancy. As Graham showed in his presentation, the impact of dormancy on the sustainability of a mobile money service can be quite profound. We've already seen that the financial impact it can have on subscriber acquisition is quite high, but dormancy can also impact the operating costs and overall profitability. When you have a very high inactive user base, then each active customer must generate a large amount of revenue in order to cover the costs of the service. In this situation, we are seeing operators make a fatal mistake, and that's that they raise the transaction fees or lower the amount of incentives provided to the agents in order to improve their bottom line. Instead, operators should be focusing on tactics that stimulate usage and acquire more active customers. When you have marketing dollars, they should be invested wisely into areas that are more likely to generate these active users. So in this presentation, I'll focus on taking you through some of these tactics that we've observed that make this possible. But before we can talk about how to acquire customers and stimulate usage, we need to understand what environment is required to foster mobile money usage. One of the commonalities we've seen between some very successful mobile money services like M-Pesa and MTN Mobile Money in Uganda is that all of them were in markets that were ripe for the introduction of mobile money. So what does that mean? Well, basically, there are a few factors that contribute to this. The first is to be in a market where there's a high need and there are few competitive alternatives. When M-Pesa launched their Send Money Home campaign, people were used to sending money to their villages through strangers that were traveling in that direction. So when Safaricom started to advertise the benefits of a secure and cost-effective alternative, they had a large market of people with a dire need. It also helps to be in a market where the regulatory conditions are favorable. If the regulator hasn't yet introduced any legislation for mobile money, then you're in a very good position to be able to influence this in the right direction. The third requirement is to be in a market where it's possible to set up a wide network of cash-in and cash-out agents. These agents need to be able to reach into communities where there is a need for the service. And finally, obtaining a large base of customers that are actively using your service usually starts with having a critical mass of customers that you can market the service to. What we can take away from the successful services in market to date is that they all had a large market share when launching their services. A large market share is helpful for a few reasons. Firstly, mobile money customers will be pre-existing mobile subscribers. So if you have access to these customers, then you're more likely to generate high adoption rates. Secondly, any successful payment system requires a critical mass of adoption in order to be sustainable. Having a large pre-existing customer base is important to reaching an adequate level of adoption. And lastly, operators with a dominant position in the market usually have greater power and control over the airtime distributors. So this can be important in getting an agent network scaled up effectively. So what do you do if you don't have a dominant market share? In this situation, one option is to consider partnering with another provider to reach a much larger base of customers. In markets where there are many small players, it makes sense for providers to get together and to form open coalitions where interoperable services can be provided. This benefits everyone in the market, including the customers who are then more likely to remain as active customers. But if you do decide to form partnerships, it will be very important to carefully consider the strategic fit between you and your partners. In a recent report by Oliver Wyman and Planet Finance, the authors say that in their experience, the effort and time required to align partners on strategic areas can lead to significant delays in the project launch. Some of the most common issues they encountered were in the choice of services, the pricing, the target segments, and branding decisions. For example, in the case of a pilot project in West Africa, where a microfinance organization partnered with a local mobile operator, the MFI already had 10 existing and planned products, alongside its own money transfer service, and all of this needed to be aligned with the operator's existing mobile money products before they could launch a joint service. So you can imagine the amount of discussion that was required in order to bring these services to market in a co-branded manner. So what are some good questions to ask in order to determine a good strategic fit between partners? One important area to discuss is what role each partner will play and how you will divide the responsibilities. For example, which partner will take responsibility for registering customers and ensuring all of the regulatory requirements have been met during this process? This is especially important to clarify very early on because it can impact the way you are governed by the regulatory authorities. Another area that requires alignment is the type of services that will be offered and the timelines in which those services will be brought to market. It's also important to discuss the customer segments that you will market those services to. Probably one of the most contentious discussions you'll have with partners will be around goal setting and investment decisions. For that reason, it's important to decide as early as possible in the partnership how much each partner will invest and what timeframes those investments will be in. We have observed a number of failed projects because organizations rush to market with new product developments and marketing initiatives, but they haven't thought through the investments that are required and haven't determined where those investments will come from. Especially when it comes to the development of the agent network that is required to support your mobile money service, you can't underestimate the amount of investment this requires in order for it to be successful. Finally, you need to agree on what design principles will guide the development of the services. For example, will you make a trade-off in security in order to make the service more simple for users? Do you have a high base of illiterate users that will need special assistance? Will you use existing assets, or will you start development from scratch? You may be an organization that already has an existing product, and you're looking at partnering with another company that also has an existing product. In this case, many of your discussions will be around how to merge the services and how to present them to the user. If you focus on making sure these points are clarified before sealing the deal on a partnership, you're more likely to bring the service to market faster and to have access to a critical mass of customers, and that will be vital to stimulating a high number of transactions through your service. Okay, so let's look now at some other factors that can impact the usage of your service. As Graham already mentioned in his presentation, managing liquidity is a big challenge and one that can have a severe negative impact on mobile money usage rates. One of the biggest complaints customers have about M-Pesa is the fact that when they go to an agent outlet to withdraw money, many times the agent doesn't have enough cash to fulfill the request. In some cases, customers can go back for days in a row waiting to be able to get their cash out. Not only is this an inconvenience for the agents and the customers, but it also decreases overall trust in the system. And trust is already hard to come by, so you don't want to make it harder for users to trust the system. But the liquidity challenges not only have a negative impact on customers, they also have a negative impact on agents. Because cash tends to flow mainly in a single direction from urban to rural areas, this means that agents need to rebalance on a regular basis. The cost of having to rebalance can represent as much as 50% of an agent's total expenses, and some agents can revolve their credit up to 3 times per day. If we look at the incentive structures for agents, we see that when a service initially launched, agents are receiving very high commissions that mainly come from bonuses that are paid to encourage a high number of user registrations. But over time, the commissions for agents can fall dramatically. This is also because as more and more agents are brought on board, transactions will be spread across multiple locations, and each agent outlet will be servicing less customers. At this point, it's extremely important to stimulate each customer to perform more transactions, not only because it helps to improve the operator's bottom line, but also because it helps to keep the agents incentivized. If agent commissions fall to a level where the agents are no longer profitable, then they are likely to stop servicing customers. As we saw from the example in Graham's presentation, customers are likely to stop using the service, and here you'll be in a very negative cycle that would lead to even more inactivity. One way that you can stimulate more activity at agent locations, especially in the rural areas, is to design your service in a way that encourages viral registrations. For example, both M-Pesa and MTN Mobile Money are designed in a way that allows customers to send money to an unregistered user, even if that unregistered user is on another mobile network. The key here is in the pricing scheme that they use. To send money to an unregistered user can be as much as 3 times more expensive than sending money to a registered user. So a sender has an incentive to encourage family and friends that they will be transacting with regularly to go and register for the service. When we look at the more successful mobile money services in market, one thing we can see is that they have all invested a considerable amount of money and effort into making the service a part of the customer's daily life. These services provide a variety of use cases that touch the customer in many different ways. If we want customers to remain active, then we have to provide them with a multitude of services that are both relevant and convenient to them. The goal here is to make mobile money an essential part of their daily routine. Each family member might do different things with their mobile money service, but these transactions are things that they will do on a regular basis. So one way that you can ensure there will be a variety of services available to your customers is to consider making your platform easily available to application developers through open standards and the provision of APIs that allow them to easily connect to the mobile money platform. In Kenya, Safaricom has invested a large amount of money in developing a variety of services, but many people argue that this would be way more efficient and innovative if technology companies were also enabled to provide value-added services. Earlier in my presentation, I talked a little bit about the importance of spending marketing dollars wisely on initiatives that are most likely to yield a high number of active customers. To give you a bit more insight on what those areas might be, I'm now going to look at the example of a mobile microfinance pilot that was done in Southeast Asia. In Beyond Payments, a report by Oliver Wyman and Planet Finance, the authors documented the success of various marketing initiatives that were conducted during the pilot. The campaigns included a community event, such as holiday celebrations, that was co-branded with the mobile operator. The event served as a platform to build awareness about savings. The impact of this campaign was significant because it led to an activation rate that was much, much higher than their traditional marketing approach of door-to-door sales. The biggest reason for this impact is because the marketing was done at a time when it was relevant to users since they had excess cash available to save. The authors provided further evidence of this fact when they say that they saw less than 0.2 deposits per month per customer in periods before the harvest season, and that's when people typically have negative cash flows. But during the festive season, they saw this rate rise to 0.5 deposits per month per customer. In many countries, salaries are only paid at a certain time of the month, and we observe a spike in spending around that time. So as a mobile money provider, if you focus your marketing efforts on times when you know your customers are likely to have cash available, then you're more likely to stimulate usage at those times. Another takeaway from this diagram is the importance of word-of-mouth or customer recommendation campaigns. We have seen this in nearly every market where a successful mobile money service has been launched. Gaining users' trust is a critical aspect of maintaining active users, and the first step in this is often to encourage the agents and other users to recommend the service to their family and friends. So now that we've seen the importance of generating relevant marketing campaign, let's look at some of the tactics that can be helpful in doing this. Many mobile operators are already using a loyalty program to prevent subscribers from churning and to encourage subscribers to purchase additional airtime or to send more SMS messages. Those same principles can be used to encourage adoption and usage for mobile money. Many of our customers use the 6th Sense media platform to generate attractive, real-time loyalty campaigns and to trigger users at a time when they are most likely to respond. The system uses a variety of profiling data that determines the right campaign and time for each user. Even if the subscriber doesn't respond to the campaign, the result will be stored in the platform so a follow-up offer can be made. And after each campaign is run, the marketing manager has the chance to closely monitor the success and to view other metrics that are important through an intuitive marketing dashboard. If we look at the example of Zane Group, who is using a real-time loyalty platform, we can see that the system helps them get campaigns into market quickly and efficiently. Because the offers they are making to customers are relevant and real-time, the success rates are dramatically higher. Points-based loyalty programs are another attractive way to encourage users to continue transacting. We see this in many other industries, from frequent flyer miles to loyalty cards that are used in grocery stores. Users like to know that they're getting something extra when they make a purchase. When a customer completes a mobile money transaction successfully, they're almost always given a confirmation message. No matter what format this message is sent in, here you have an excellent opportunity to communicate with the customer and to inform them of special promotions or offers that they can take advantage of for being a loyal customer. By offering these promotions, you're also encouraging users to try additional functionality in the system, and this is usually functionality that they wouldn't otherwise be aware of. When we look at the link between loyalty and mobile money systems, it makes sense to focus our loyalty campaigns on specific areas that present challenges for mobile money adoption and usage. As you have already heard in this webinar, one of the biggest barriers to customer acquisition is gaining the trust of a customer. Previously, we have seen that agent and user referrals can make a big difference to the number of customers that register for a service. So in this case, it would be a good idea to use a loyalty platform to create a recommendation campaign. The campaign would be targeted to early adopters and heavy users, since those are the customers that are likely to be satisfied with the service and will make a good recommendation. These people are also more often likely to be educated about the use of mobile phones and will be able to help their friends and family through the first transaction. A real-time loyalty platform can be used to profile customers and to identify the correct segment to target this campaign towards. Once you've been able to trigger a high subscription rate, the goal is to encourage users to try new services and to make mobile money a part of their daily life. As we've already seen, usage campaigns should be relevant and timely in order to have the highest conversion rate possible. One example of how you can use loyalty to accomplish this is to generate a campaign based on when a customer is likely to have excess money to do a transaction. For example, if you trigger a campaign when someone has just received their salary or a money transfer, you can encourage the user to do a transaction with those funds. A real-time platform can be used to monitor the location of the customer, so you can even trigger the user when they're near an agent or business that supports the service. If you're successful in encouraging usage, the battle's still not over. Now we need to make sure that people can move money around the system easily, and this means carefully monitoring and maintaining the liquidity. You can also use a loyalty platform to encourage agents to maintain a balance between cash and mobile money. As I mentioned earlier, it's important to continue to incentivize the agents to provide good customer service and give out bonuses to high-performing agents that maintain a liquid float. In our experience, using loyalty service to address the challenge areas in mobile money can go a long way towards stimulating adoption and usage. For that reason, SciCap has been leveraging our long-standing relationship with one of the leading companies in loyalty services. We've been working with Sixth Sense Media to design specific solutions that address the challenge areas of mobile money, and together we use our combined experience in loyalty and mobile money to create relevant and real-time campaigns. So to summarize some tactics that are helpful in combating dormancy, the first step is to attain a critical mass of users. If we take an example from existing payment systems, it's clear that for such services to be sustainable, you need to have a critical mass. In order to get that critical mass, you should have access to a large base of customers and this is more likely if you form partnerships or participate in open coalitions. Another important factor is to have a wide enough distribution network to support these customers and make cash in and cash out convenient. This means agents need to be highly liquid, and often that means incentivizing the agent network appropriately. You should also design your system in a way that encourages viral registrations. Even if you do have a large subscriber base, you haven't yet won the battle. Many operators tend to focus on the registration metrics, but the better metric to focus on is the number of active subscribers. In order to stimulate usage amongst your subscriber base, you should provide a variety of services and make it easy for other companies to do the same. When you do spend money on marketing your services, make sure those investments are relevant and timed well. And one of the best ways to ensure this is to use a loyalty program that generates real-time and relevant campaigns and will allow you to continuously monitor the impact of those campaigns. So that's all I have for today. Thanks to everyone for listening, and a special thanks to Graham and the team at Clarion for hosting this event. And now I'll just hand it back so we can go to the live Q&A.
Well, thank you very much, Alida. Now we get to the time when we answer some of the questions that the audience kindly sent in beforehand. We've had some great questions come in, and what I'd like to do is perhaps ask Alida to start with a couple that she had chosen to respond to, and then I'll take a couple of the ones that I thought that I might be able to handle. So Alida, would you like to kick us off?
Sure. Thank you, Graham. The first question that I got was from a user that asks, normally acquiring a customer is more costly than maintaining or retaining a customer. So why is dormancy a problem then? Saving accounts are sometimes without transactions for a longer time. And my response to this is basically, in order for a mobile money service to become profitable, it is important to stimulate an active usage amongst the customer base, because a large portion of the return on investment from these programs comes from transaction fees. And because customer acquisition is more expensive than customer retention, the only way that providers can recover the investment they make on acquiring a sub is to make sure that those customers are actively transacting. In many mobile money systems, the transactions are usually very price competitive because there are other alternatives in the market to moving money. And this is the only way that the operators are able to stimulate a high adoption rate. But that means that the margin on those transactions are going to be fairly low. So stimulating high volumes would be a requirement for a healthy business case. Another factor in this is that the technology vendors of the platforms usually charge on a per-seat basis. So the operators are paying for each sub that they register. And that means that they want to stimulate as much usage from those customers and make sure that the users are paying back their cost on the platform. When we look at the business case for banks, especially banks that have a large storage of savings accounts, there's a very different business case here. They're not actually earning their return on investment from transaction fees, but rather from the interest that they earn on lending. So that's why for a mobile money service, it's very important to generate high usage, because the return on investment is actually coming from those commissions on transactions.
Great. That's fantastic, Alida. Do you want to take a second one as well, or shall I jump in?
Sure. I'll just do one more, and then you can jump in.
Great.
Another one that I have is we have tried requiring or assisting an initial transaction, usually a top-up at customer registration. Do you find this to be an effective approach? And in my view, yes, I think this can be a very effective approach. When a customer does a transaction once, especially in the presence of another user or an agent that can walk them through the process, then they're much more likely to remember how to do this later on. Another thing that I've seen in many markets is that after registration, many of the customers will have problems with their PIN if they don't complete a transaction immediately. So when you do require them to do a transaction, then you can resolve many of those PIN issues. And those issues are usually what drive high volumes to the customer call center. So in reducing those PIN issues, you can keep the calls to the customer care center down and therefore keep your costs low. But one thing that is important to remember when you use this strategy is it'll be very important to train the agents on customer education practices and to incentivize them to treat the customers properly and to take them through the first transaction properly. Because what you don't want to have happen is a customer who tries to do the first transaction or is required to do the first transaction and can't get through it successfully and therefore is not likely to use the system again. So it is very important to educate the agents and other high usage customers on how to help other people in the market do those transactions.
Yeah, absolutely. I think there's a very, very good points, and they reflect on one of the questions that came in for me, which was what is the biggest stumbling block in respect to dormancy? Is it incomplete training, lack of products that consumers actually want, or that expectations from operators are too high, or something else altogether? And I think, of course, this varies hugely from market to market, and one could add other problems to the list. I mean, we've operated in markets where the platform is simply not adequately stable. So way too often the customer comes into an agent to make a transaction and the system is down, and so they can't, and they have to leave disappointed, even if they got through the first 3 or 4 transactions that made them enamored with the system. But I think that if one can get a good, stable system up, and as Alida says, you have the agents who really help the customers, walk them through the first couple of transactions in a way that is, seems as painless as possible, then the issues really become the product and the cost of the product. And one of the things that we've seen and we worry about a lot at MicroSave is that a lot of the solutions being rolled out there nowadays are targeting remittance or payments because those are the highest pain points for customers, and therefore you can charge the highest amount for those transactions, which is fine from a sustainability point of view in the short run, but risks reducing other transactions, savings accounts and so on, because the transaction fee is so high. If I go to another question, hang on a second, I've got to do the technology here. Another question that came into me was, why don't banks see the value in dealing with poor clients? On one hand, microfinance institutions in India have been blamed for making huge profits out of the poor, and on the other hand, banks are saying dealing with the poor is a loss-making business. Where is the gap? This is an interesting question, but in fact reflects a little bit, I think, perhaps on what I've just said. The reason I think microfinance really was largely microcredit was that from a sustainability point of view, the largest margins, quite apart from the regulatory issues, the largest margins are usually made on credit. It's a lot easier to move to institutional break-even much quicker through a credit offering than perhaps anything else. With the introduction of mobile money, now we've got a situation where remittance and payments are perhaps the easier option given the nature of the platform that we offer through a mobile money solution. But in my opinion, really, if we offer these sort of mono-product solutions in the name of financial inclusion, we're missing a tremendous opportunity. Poor people need a wide range of products and services, and I think mobile money offers a tremendous opportunity to offer that range of products and services. And if we get to a stage where we offer the right products on the platform at the right price, then I think we'll see very significant uptake and very significant numbers of transactions. And I think that should be our ultimate goal, rather than sticking with underutilized payments or remittance platform.
Graham, I think that's an excellent point. And in fact, one of the things I discussed in the presentation was that making mobile money a part of users' daily life goes a long way towards increasing their usage. So really our goal, I agree with you, is to have as many products and services available and to make this second nature for them so that they actually rely on mobile money as their primary payments channel and channel to do many other financial service transactions.
Yeah, absolutely. And of course, easier said than done. One shouldn't underestimate that it is complicated. But that has to be our ultimate destination, to move towards some form of cash-light ecosystem.
Absolutely. Okay, if I can take another question that came in during the presentation then. The
Sure.
question is, does corruption pose a threat towards trust? Here I would say the question was more about in the emerging markets and developing markets where there is corruption, would it be the key barrier for adoption? I would say it's not necessarily a barrier for adoption because of trust, but it can make regulatory compliance more difficult. So in those areas, the regulator is going to probably have more stringent registration procedures, and that can definitely affect adoption. One example I have is when we were working on the launch of M-Pesa in Afghanistan, the regulator there required us to collect a lot of personal information about customers when they registered in order to screen for anti-money laundering. And, upon launch, what we realized is that culturally providing that kind of information was not acceptable for many of the customers. So there we definitely saw this impact adoption. So here it's going to be extremely important to understand how to strike the balance between what the regulator requires and, what is going to be acceptable in market. And again, that's something that's easier said than done. But if you engage with the regulator early and you're able to have open discussions with them and, really show what the impacts can be upon market launch, then this is something that would help to create that balance.
Yeah, no, absolutely. Okay, I have, Anita, you have one more question, I think, right?
Yeah, I do. Another
Fantastic.
question.
Why don't you finish that one off, and then I've got one more at least in front of me as well.
Okay, so this one will be a quick one. Is dormancy a payments problem or an ecosystem problem? Here, I would say a large part of dormancy is an ecosystem problem, but it really depends on the market. It can be both. In markets where there isn't a high need for the services or where there are a lot of competitive alternatives, then dormancy can be related to payment behavior, such as in the developed markets, where people have a lot of options and many other ways to make payments. Then here I would say it's really user behavior. But if you're operating in a market where there's a high need and there's no suitable alternatives, such as many of the emerging markets, here focusing on building and incentivizing the agent network and thus the ecosystem, that's really going to go a long way towards success.
Yeah, absolutely. I agree entirely. And we here in India have been doing some sort of what we call rapid agent assessments of the agents across India, and really they're at this stage they're frankly underutilized primarily because they are not adequately trained or supervised, and as a consequence don't have an adequate business case, and as a consequence don't have adequate liquidity, and so you get a sort of self-perpetuating problem there because if they don't have the business case and they've not been trained properly, the service they offer is substandard, and so customers don't come, so they have even less business, and the cycle gets worse and worse.
Right, exactly.
And we've seen this in several countries where we've worked on agent networks. It seems to be one of the most prevalent problems. I rather worry that building that agent network is the sort of great underestimated challenge, because many MNOs, for example, say, well, agency, that's what we do. We've been selling scratch cards to agents forever and a day. But it's a very different business, setting up financial services agency.
Right, exactly.
So the last question I had was, will increasing the product base on mobile accounts lead to better activation levels and lower dormancy? And I think the answer to that we've begun to unpack a little bit. I mean, it obviously depends on the ecosystem we've been talking about. It also depends on the nature of the products and whether they're appropriate or not, whether the marketing and communication around them is adequate, and also what sort of incentives are in place to encourage usage and uptake. Yes, in principle, but subject to lots of riders. And what we see, I think, worldwide is a tendency to start with some anchor products, usually remittance or payments, because, as I say, those are the high pain points. And then once you've got those anchor products in place, then a move over time, hopefully, to diversify the product offering. But there is this challenge, of course, that if you have MNO-led solutions, there's a finite amount that they can add to the product suite because of regulatory environments and so on. And so I think that over time, we will see more diversified product offerings coming across these platforms from bank-led models, which will then be able to offer the proper savings options and credit and so on. And I think that's when it really gets interesting from a full financial inclusion perspective. So I think we've probably run out of time and stretched the participants' patience to breaking point. So it really leaves us to thank Alida for her tremendous presentation and very thoughtful responses to all the questions. Thanks so much for joining us, Alida. We really appreciate it.
Thank you,
And I hope that everyone will join us for the next mobile money webinar, which will be sometime in February. Alida, any final comments?
No, I just wanted to say thank you. Thank you to all the participants. And I think we have some questions left over, and I will do my best to get back to those that are specific to my presentation through email, and welcome any questions that haven't come in already. If you'd like to contact me by email, that's fine as well.
Fantastic. Thanks so much, Alida. And I would say the same from my perspective. If you want to get in contact, please do just send us an email. And several of you are kindly asking for the presentations. That the entire webinar will be up and available on the Clarion website, I think, for the next year or so. So you'd be most welcome to revisit it. Thanks so much again, Alida. Thank you to Clarion. And with that, we'll say, from my side of the world at least, good night. And from the UK, I think it's good afternoon. Goodbye now.